every deal, of course, comes with its share of risks, whether in this case, with one analyst here saying a bloated balance sheet bloated with debt, more complicated business, so to speak. What made this deal worth taking on the risk to get it done?
Well, first and foremost, we get incredible brands, incredible capabilities, and a great management team. It's very complementary to our business. We get Peppa Pig and PJ Masks, as well as a stream of new content. Be on the lookout for Ricky Zoom, which is starting to air around the world, and a great deal in the U.S. with Nickelodeon. And you'll see other brands in the development pipeline where we can then also put Hasbro IP through that great capability based in London. We have a TV and film side. What we're really seeing there is that we increasingly are developing our Wizards of the Coast brands like Magic the Gathering and Dungeons and Dragons. We've said we could double the size of those brands again, as we've done over the last 5 years. We're really driving into gaming with Magic Arena. And we're seeing people now offer us opportunities for this deep IP with incredible mythology and canon to be in the stream space and the OTT space. We want to have those capabilities with the teams that can drive it. We have a commitment to return to that. Oh, sorry, I was going to say we have the commitment to return to the 2 to 2.5 times leverage.
Right.
We've had a fortress balance sheet. We want to continue to be that kind of company, maintain our dividend. But we really see this as being complementary to our business, and we've been very thoughtful and strategic in our approach.
All right, Brian, Jim Cramer, good to see you in a different hour. How have you been?
Yes, hi, Jim. Good, doing well.
Okay, I've got to ask you, this is somewhat of a diversification away from traditional toys, and a lot of people are worried about the traditional toys being built in China. You had China exposure. You've been moving out of China. People say, you know what, it's easier to move a toy factory than it is to move a semiconductor factory. How have you found the diversification away from China going?
Well, it's gone very well for us because, as you recall, we are an asset-light company, so we don't own any factories anywhere in the world. In the U.S., for the U.S., we produce about 20% of our revenues in the U.S. for our U.S. business. Globally, it's about 2/3 of our business coming out of China, but that's down substantially from nearly the 90% where we were in 2012 when we made the decision for enterprise risk reasons to begin to diversify. We're seeing great opportunities in Vietnam, in India, in other territories like Mexico. And even more we're doing in the U.S. We brought Play-Doh back to the U.S. last year. We do our Magic the Gathering trading cards here and board games here in the U.S. So we're seeing an opportunity that will lead us by the end of 2020 to be at about 50% or under for the U.S. market coming out of China. And we believe by 2023 we should be under 1/3. And this has all to do with our strategic sourcing footprint, expanding our channel strategy, and being smart and strategic about where we source our product, recognizing we want to make a safe product, a high-quality product at a value price.
Also, let's talk about the acquisition for a second, because I think the acquisition is brilliant because I want you to be more than toys. But this seems to be what people have been saying over and over again. There's a giant opportunity for over-the-top, and someone's going to take it. You've decided to seize it. How much of this initiative and this acquisition will be about providing the content that everybody's short of?
Well, what we're really seeing are amazing partners like the Walt Disney Company building these incredibly exciting platforms, and we think that's great. And they want to have their IP on their platform. So there are other platforms that are out there that need great IP. They're coming to us, and we're having conversations. We have a number of priority projects with Paramount, but beyond that, we own nearly 1,500 brands. Many of those brands have a great legacy. They've been comic book brands. They've been toys and games brands in their history. They have great mythology, and we need that bandwidth, great storytellers, and the management team and the capabilities, along with eOne, who brings this profitable television and film business with best practices in how they go to market around the world to help accelerate our efforts. This really does change our revenue and earnings profile, our thought process about our growth rate over time.
Wanted to follow up on the cultural combination you're putting together here, Brian, because Entertainment One also owns Death Row Records, founded by Suge Knight. I mean, that's a pretty interesting portfolio to have that, and then to also have Peppa Pig and My Little Pony. I mean, what does that all look like culturally?
Yeah, well, Death Row is a very small piece of the music business, and we're really focused in on the bigger parts of the biggest business to begin with, but recognize what we're seeing in music is everybody's using music in everything that we do, from our advertising to our television to our motion pictures. Other people are using music, and they have a great capability of providing that music to ad agencies and other creative businesses that are making video content. And, you know, in due time, many people have asked us about different assets that eOne owns, and in due time, we'll have conversations about what's the best use of those assets.